From my perspective, I've never been a big believer in flows as a driver of market. I mean, of the market. I mean, in the short term, clearly it's going to have an influence. But the more important impact over the medium term is what's going to drive Chinese corporate profits. And from that perspective, the corporate profit outlook is still fairly challenging, particularly for the major parts of the index, which are the SOEs and particularly the banks.
So it's all a bit academic, really, isn't it? You need to see nuts and bolts, you need to see the nitty-gritty, the fundamentals improve before you get any conviction. So how do you approach Chinese equities? If you are patient capital, if you want exposure to China, how do you do it? What's the best vehicle? What's the safest vehicle from a risk-reward point of view?
Well, I think there's absolutely no doubt that most global investors are quite pessimistic on China already. So from a beliefs or behavioural perspective, people are already fairly bearish. The bad news is that the way prices are behaving suggests to me that it's still, basically a bear trend. When I look at particularly the HSCEI, or the Hong Kong listed China Enterprises Index, which is basically still in a downtrend. The good news is that valuations are extremely cheap, as I mentioned. So you're getting on mid to low single-digit PEs for the broader index. It's just that index is so concentrated in SOEs and banks that there is probably a genuine structural problem in the returns, or the ability of returns to improve.
And then we've got the bad debt problem to negotiate as well. That's another
right.
story. Let's just bookend this discussion, Nick. Scramble for safe havens and sovereign bonds. You've highlighted that. Is that flashing a major warning signal, or are investors jumping at shadows here?
Well, I mean, if you just looked at the S&P 500, investors would be feeling, a bit happy-clappy. But when you look under the hood of the market, the cyclicals are still not really behaving that in a very encouraging fashion. Cyclicals have certainly bounced from the January low, but they're still broadly underperforming, in a trend sense. And as you mentioned, the Treasury yields, particularly the long end of the curve, is basically still flattening, or the yields are still coming down, and that doesn't suggest, or to me, it's not consistent with the Fed's narrative of improving growth. If the Fed's narrative was really correct, the yield curve probably ought to be steepening.
So stay cautious until we get some clarity from the Fed and until Brexit is settled, yes?
Well, yes. I mean, we've got a pretty cautious position going into the summer. It's partly at a global level, and particularly in the S&P 500. It's partly a valuation call as well. That you've had some cyclical improvement in the profit news flow, but it's still fairly unconvincing, and the S&P 500 is getting to more overvalued levels.